I want to say something that is going to sound wrong for about 30 seconds, and then I'm going to show you exactly why it is the most mathematically correct retirement advice you have heard in years. Stop saving. I do not mean stop putting money away for retirement. I do not mean spend everything you earn and hope for the best. I mean stop doing the specific thing that most Americans call saving, which is depositing money into a traditional 401k or a traditional IRA, watching the balance grow, feeling good about the number, and assuming that the number you see on the statement is the number you will actually have available to spend in retirement, because it is not. The number on your traditional retirement account statement is not your money. It is your money plus the government's cut, bundled together in a single account, displayed as a single number, in a way that makes the government's portion invisible until the day you try to spend it and the tax bill arrives. And here is the part that changes everything when you see it clearly. The strategy of maximizing contributions to a traditional pre-tax retirement account, which every HR department, every 401k provider, every generic financial planning website tells you is the right move, is in many cases the strategy that takes the longest to reach $1 million of actually spendable after-tax retirement wealth and produces the smallest lifetime income once you get there. Not because saving is wrong, because saving in the wrong structure, in the wrong account type, in a way that builds a tax liability alongside the balance, is a fundamentally different thing from building $1 million of genuinely accessible, genuinely spendable retirement wealth. And the math between those two things, between $1 million in a traditional pre-tax account and $1 million in the right structure, is not a small difference. It is the difference between a retirement that works and a retirement that slowly, quietly, consistently underdelivers on every promise the balance implied. This is Retire Right America, and today I am going to show you the 2026 retirement math that your 401k provider does not want you to run, the specific account structures and strategies that build genuine spendable wealth faster than traditional saving, and the moves that actually get you to $1 million in real after-tax purchasing power in the shortest possible time. Let me give you two people. They are the same age. They are both 44 years old. They both earn $85,000 a year. They both have the same amount of money available to put toward retirement every month. Call it $1,500 per month. They both plan to retire at 67. They have 23 years. Every other variable in their financial lives is identical. The only difference is where they put the $1,500 per month. The first person, call him Brian, does what everyone tells him to do. He maximizes his traditional 401k contribution. The $1,500 goes into the traditional account every month, pre-tax, reducing his current taxable income, watching the balance grow, getting the employer match, following the conventional wisdom that has been repeated so many times it feels like a law of nature rather than a choice with real consequences. The second person, call her Karen, does something different. Karen runs the math first. Karen asks a question that Brian never thought to ask. She asks, not how much will this account be worth in 23 years, but how much of this account will I actually be able to spend in retirement, after taxes, after required minimum distributions, after the Social Security inclusion trap, after IRMA surcharges, after every mechanism the tax code uses to extract value from traditional retirement accounts during the distribution phase. Karen restructures her retirement contributions based on the answer to that question. By the time Brian and Karen both reach 67, Brian has a traditional 401k balance that looks impressive on paper. Karen has a combination of account types that looks different on paper, but produces significantly more spendable after-tax income every year of her retirement. I'm going to show you exactly what Karen did differently and why the math works the way it does. But first, I need to make sure you understand the single most important concept in this entire video, because without it, the rest of the math will not make complete sense. The concept is the difference between gross retirement wealth and net spendable retirement wealth. Your gross retirement wealth is the number on the account statement. Your net spendable retirement wealth is what you can actually spend after every tax, every fee, every Medicare surcharge, every Social Security inclusion calculation has taken its share. For a traditional pre-tax retirement account, the gap between gross and net is not trivial. It is not a minor adjustment. For a married couple in the 22% federal bracket with a state income tax of 5%, the effective tax rate on traditional IRA and 401k withdrawals in retirement, accounting for the compounding effect of Social Security inclusion taxation and IRMAA surcharges triggered by those withdrawals, typically runs between 28 and 38% of gross withdrawals in real-world retirement scenarios. That means a $1 million traditional 401k balance does not produce $1 million of spendable retirement wealth. It produces somewhere between $620,000 and $720,000 of net spendable wealth after all forms of taxation are applied across the distribution period. The remaining $280,000 to $380,000 goes to the federal government, the state government, and the Medicare surcharge system over the course of retirement. Now I want you to run that same calculation for a $1 million Roth IRA. The Roth account produces $1 million of net spendable retirement wealth, every dollar. No federal income tax on qualified withdrawals, no state income tax in most states, no required minimum distributions that force taxable income whether you need it or not. No contribution to the provisional income calculation that triggers Social Security taxation. No addition to the modified adjusted gross income that determines IRMAA Medicare surcharges. $1 million gross equals $1 million net. The difference between Brian's $1 million traditional account and Karen's $1 million Roth account is not a difference in account balance. It is a difference in actual retirement purchasing power of somewhere between $280,000 and $380,000. That is the gap between gross retirement wealth and net spendable retirement wealth. And it is the gap that the conventional save more in your 401k narrative completely ignores. Because the 401k industry makes money on assets under management, not on your after-tax retirement income. So what specifically does Karen do differently? The first move Karen makes is to understand her current marginal tax rate versus her expected retirement marginal tax rate and make the contribution decision based on that comparison, rather than on the default of always contributing pre-tax. Here is the logic. The fundamental value proposition of a traditional pre-tax retirement account is that you defer taxes from a high-income year today to a lower-income year in retirement. If you are in the 32% bracket today and you expect to be in the 12% bracket in retirement, the traditional account is mathematically superior. You save 32 cents on every dollar today and pay back 12 cents on every dollar in retirement. That is a 20 cent per dollar advantage. But if you are in the 22% bracket today and you expect to be in the 22% bracket in retirement, the traditional account provides zero mathematical advantage over a Roth. You defer the tax at 22% and pay it back at 22%. You have gained nothing except the ability to let the IRS grow its claim on your account alongside your own balance. And if you are in the 22% bracket today, but your retirement income, which includes Social Security, RMDs, pension, and investment income, is going to push you into the 24 or higher bracket in retirement, the traditional account is actively harmful. You are deferring taxes at 22% today and paying them back at a higher rate in retirement. The conventional wisdom got it exactly backwards for your specific situation. Karen runs this calculation. She determines that her expected retirement income, even with modest assumptions about Social Security and account growth, will put her in a similar or higher marginal bracket than she is in today. She shifts her contributions from traditional pre-tax to Roth. She pays the tax now at the current rate and locks in the tax-free growth for the next 23 years. The second move Karen makes is to treat the Roth IRA as a separate, parallel savings vehicle rather than as a replacement for the 401k. Many employers offer a Roth 401k option alongside the traditional 401k. Karen elects the Roth 401k option within her employer plan, capturing the full employer match, and also contributes the maximum to a separate Roth IRA outside of her employer plan. The 2026 contribution limits allow individuals under 50 to contribute $7,000 per year to a Roth IRA, with a catch-up contribution of an additional $1,000 per year for those 50 and over. Karen is 44. She contributes $7,000 per year to her Roth IRA, which is $583 per month, and directs the remaining $917 of her monthly retirement savings into the Roth 401k option at her employer. The combined contribution of $1,500 per month goes entirely into Roth structures. It all grows tax-free, it all distributes tax-free, it generates no RMDs, it produces zero provisional income. It creates zero IRMAA exposure. Every dollar that lands in a Roth account is a dollar that the tax code will never touch again as long as qualified distribution rules are followed. The third move Karen makes is what I call the tax drag elimination strategy for the portion of her savings that exceeds the annual Roth contribution limits. There are income limits on direct Roth IRA contributions. In 2026, the ability to contribute directly to a Roth IRA phases out for single filers between approximately $150,000 and $165,000 of modified adjusted gross income, and for married couples filing jointly between approximately $236,000 and $246,000. Karen's income of $85,000 is well below these limits, so direct Roth contributions are available to her. But as her income grows over the next 23 years of her career, she may eventually bump into these limits. The solution for high-income earners who exceed the Roth IRA income limits is the Backdoor Roth contribution, a two-step process of making a non-deductible traditional IRA contribution and immediately converting it to Roth. This strategy is explicitly permitted under current tax law and allows virtually any earner, regardless of income level, to fund a Roth IRA annually. The mechanics require attention to what the tax code calls the pro rata rule, which affects the taxation of the conversion if you have existing pre-tax IRA balances, and the details should be worked through with a CPA or fee-only financial advisor. But the strategy itself is well established, widely used, and has survived multiple rounds of congressional scrutiny without being closed. The fourth move Karen makes is to understand the power of the Roth conversion ladder for the money that is already sitting in traditional pre-tax accounts from years of prior contributions before she understood this framework. Karen has been contributing to a traditional 401k since she was 29. She has approximately $90,000 already accumulated in pre-tax accounts. That $90,000 is a future tax liability sitting inside an account that is growing and compounding. Left untouched, it will generate RMDs at age 73 that stack on top of Social Security and create exactly the tax cascade we described earlier. Karen begins a systematic Roth conversion strategy, converting a controlled amount from her traditional account to Roth each year, staying within her current marginal bracket, paying the conversion tax from her taxable savings rather than from the converted amount, so the full balance moves to Roth, and systematically eliminating the pre-tax liability over a period of 7 to 10 years. At her income level and marginal rate, Karen can convert approximately $15,000 to $20,000 per year from traditional to Roth without crossing into the next bracket. Over 7 years, the $90,000 pre-tax balance is substantially converted to Roth. The tax she pays on the conversion is the same tax she would eventually pay anyway during the distribution phase. But she pays it now at the married filing jointly rate in the current bracket at a controlled and predictable amount, rather than paying it later at the single filer rate if her spouse predeceases her, at an uncontrolled amount determined by the RMD schedule, with the additional Social Security inclusion tax and IRMAA surcharges piling on top. The Roth conversion ladder does not eliminate the tax, it controls it. It moves the tax payment from the worst possible time, forced distributions in the highest exposure years of retirement, to the most favorable possible time, controlled conversions in the lower income years with the widest brackets. The fifth move Karen makes is to invest the Roth accounts in the highest expected long-term return assets available within her risk tolerance, specifically broad market equity index funds with the lowest possible expense ratios. This move sounds obvious, but most people do the opposite. Most people put their most conservative, lowest expected return assets in their Roth accounts because they treat the Roth as a special, protected account that should not be exposed to volatility. This is exactly backwards. Every dollar of growth inside a Roth account is permanently tax-free. Every dollar of growth inside a traditional account will eventually be taxed as ordinary income. The mathematical implication is clear. You want your highest expected return assets, the assets that will compound most aggressively over 23 years, inside the Roth, where all that compounding happens in a tax-free environment. You want your lower expected return assets, the bonds, the stable value funds, the conservative allocations, inside the traditional account where there is less growth to be taxed and where the tax drag on modest returns is less damaging. Karen holds her total market index fund and her international equity index fund in the Roth accounts. She holds her bond allocation in the traditional account. The overall asset allocation, the mix between stocks and bonds, is the same as Brian's. The location of those assets across account types is completely different. And that location difference, compounded over 23 years of tax-free equity growth inside the Roth structure, produces a meaningfully larger net spendable retirement wealth than Brian's identical allocation inside the traditional structure. Now let me show you where Brian and Karen end up at 67, with the same $1,500 monthly contribution over 23 years. Assuming a 7% average annual return on both portfolios, the gross account balance for both Brian and Karen is approximately $1,120,000. The statements look almost identical, but here is where the paths diverge completely and permanently. Brian's $1,120,000 is entirely in a traditional pre-tax account, accounting for federal and state income tax on distributions, Social Security inclusion taxation triggered by traditional withdrawals, and IRMAA surcharges on Medicare premiums. Brian's effective net spendable retirement wealth is approximately $710,000 to $750,000 over a 20-year distribution period. The government collects the rest through the mechanisms we described. Karen's $1,120,000 is substantially in Roth accounts, with a small remaining traditional balance from the early years of contribution before she understood this framework. Karen's effective net spendable retirement wealth is approximately $1,050,000 to $1,080,000 over the same 20-year distribution period. Same contribution, same time horizon, same investment returns. Same gross account balance at retirement. The difference in net spendable retirement wealth is between $300,000 and $370,000 in Karen's favor. That is the real cost of saving in the wrong structure. Not a small adjustment, not a minor optimization. A $300,000 difference in the actual money available to spend during retirement, generated entirely by the account type decision, not by any difference in income, contribution rate, investment selection, or financial luck. Here at Retire Right America, we cover this topic with this level of mathematical detail because the conventional retirement savings narrative is built around gross account balances, and gross account balances are not what you live on in retirement. You live on after-tax income. You live on spendable cash flow. You live on the money that actually lands in your bank account after every government claim has been satisfied. The system is designed to make you feel wealthy based on a number that includes the government's portion, and then to collect that portion gradually, invisibly, systematically over the 20 to 30 years of your retirement through mechanisms so distributed across different line items on different forms that most retirees never fully understand how much they are paying or why the comfortable retirement the statement implied never quite arrives. I'm not telling you to stop saving. I am telling you to save in the structures that build genuine spendable retirement wealth, not structures that build impressive-looking statements that quietly include a 30% liability payable to the IRS on demand. Go to the comment section right now and tell me your age, your current contribution structure, and whether you are in a traditional pre-tax account or a Roth or some combination. Tell me your approximate current marginal federal tax rate and whether your employer offers a Roth 401k option. From that information, I can tell you in a reply what your single most impactful account restructuring move is and whether the backdoor Roth strategy is relevant to your income level. Drop your situation and we analyze it together. This is what the Retire Right America community is built for. Real numbers, real analysis, real moves that change real outcomes. Like this video, if the difference between Brian and Karen's retirement changed the way you think about where your monthly contribution is going. Subscribe to Retire Right America and hit the notification bell so every piece of retirement math we produce reaches you before the relevant window closes. Share this with someone who is still in the accumulation phase and has never questioned whether their traditional 401k is building the kind of wealth they think it is building. Because the $1 million retirement they are working toward might be $700,000 after the government takes its share. And the time to understand that difference is now, while the account structure can still be changed, not at 73 when the RMD notice arrives and the options have narrowed to none. This is Retire Right America. Stay informed, stay protected, and build wealth that is actually yours.